Welcome to the Property Investing Roadmap Podcast.
I would say once the thought is in your head, we would like to invest in some property, have the conversation.
Make time and discipline your friend.
I'm your host, Damian Collins, here to help you navigate the twists and turns of property investing.
The true investors are the ones that ask the right questions, but then make a very quick decision. And they're the truly wealthy ones.
For real success, you need a real strategy.
Buckle up as we hit the road with expert tips, real life stories, and the 9 key steps to help you plan, build, and optimize your property portfolio.
No one's going to invest to make a loss. You're going to make profit.
Today, we're diving into a topic that many aspiring property investors are curious about: how to go from owning just one property to building a multi-property portfolio. ATO statistics tell us that most people only get to one investment property. It might seem daunting, but expanding your property portfolio beyond this is far from impossible. With the right strategies, it's actually easier than you think. Now, in today's episode, we'll be exploring how you can leverage your first investment property or home to expand your portfolio, how to get the right finance structures in place to support portfolio growth, and common pitfalls that could hold you back from building a multi-property portfolio and how to avoid them. Joining me today to break this topic down is Caylum Merrick, Manager of Momentum Wealth's Property Strategy and Finance Divisions. Caylum, it's great to have you on the show.
Thanks, Damien. Great to be here.
And look, for the listeners out there, Caylum's been a long-standing member of our team at Momentum Wealth. He was a broker at one stage and now managing the division, and not only the finance team but also the property strategy team. And they really work close hand in hand, don't they, Caylum? Property strategy and property finance.
Yeah, absolutely. Property strategy and acquisition strategy. It's all bundled into one thing. So it's important to make sure we get this right from the get-go.
Yep. So, Caylum, when our clients come and talk to us, I'm assuming certainly based on my experience, most of them don't come here just to buy one investment, do they? Often they want to buy many, many more. Is there a rough number anyone people have in their head, or is it just they just want to buy as many as possible?
Good question. I think everyone's a bit different. We see a bit of everything, obviously. I think, and we try to help clients understand that the main thing you want to be doing in your acquiring years is to try and get as many high quality properties as you possibly can, within reason that you can hold for as long as possible, and that's where the compounding capital growth comes in and plays its part. So yeah, we get some people aspiring for 10, 15, others happy for 2 or 3. And
what do you think the most common misconception is about what they need to do to start getting those second and third properties?
Yeah, I think a lot of people, because obviously buy your first home, you need to save up a deposit. So you're working, you're putting your money away, and that can take some time to do. So I think a lot of people don't understand that there's another strategy that can help accelerate that whole process, and that's leveraging the equity in your property. So that's where obviously the equity is the difference between the value of your property and what you owe. And most lenders are happy to allow you to take some of that equity out and use that towards acquiring more properties.
That's one thing I always say to investors is you've got to save for that first deposit generally on your home, and that's always the hard part. But if you buy the right home in the good area that is going to grow in value, or you buy the right investment properties, well, generally you don't need to save another deposit. It's nice if you have, but you don't actually need to do that, do you? You can actually leverage the equity in those properties to buy the next one.
Absolutely, yep. And we that's a very common strategy we use for our clients. And yeah, I mean, if you had to sit there and squirrel your pennies away and wait for that next deposit to happen, that could take years and years and years, and you can miss property cycles and upside and all that kind of stuff. So it's important to note, though, not every property will just generate equity over time. So you're right with mentioning the fact that it does need to be a good, well-selected asset at the beginning.
Well, just explain the process then. So say an investor comes in and they've already got equity in their home or their current investment property. What's the process then to know, well, how much can they use to get into the next subsequent investment property?
Yeah, so I guess the first part is to figure out what that property's worth. Now, that's not market value. That's not what you could go out and sell it for today. We want to know that the banks think it's worth, and those figures will often be different. Another thing I'll add as well is that the banks don't all value your property the same either. So don't just go to your existing lender and find out what it's worth and go, oh, this is what's available to me. Engage a broker. They'll have access to different lender valuations, and sometimes you might find a lender that is willing to value it a lot higher. than another lender, and that could be the difference between a good quality next asset or something, subpar or average. So the first part is figure out what it's worth. The second thing is we want to calculate what's known as lending equity. So obviously equity, difference between your property value, what's owed. Lending equity is generally 80% of that valuation. So in an example I'll give, say your property's worth $500,000, the lending equity is roughly going to be 80% of that figure. So the bank will let you go up to $400,000 in this example, and increase your loan back up to that. So if you owed $175,000 on your mortgage, you could borrow out back another $225,000 and put that towards another investment property, and that covers your deposit, your costs, if you engage a buyer's agent, cover all those fees, and then your mortgage broker can just source the normal purchase loan with the same lender or even another lender if they're offering better terms.
So let's just break some of that down, right? So we go through the property valuation. So as a broker, we can get a value. Can you go to a panel? There's a process, isn't there? And that doesn't cost the client, does it, to get that opinion?
No. It's a bit of a complex process, and I guess that's why you want the right people who know what they're doing and can kind of navigate all that to get the best result. If you're trying to sort all that out by yourself, you're limited in your knowledge. And so an example is that there's different types of valuations the banks do. Some will spit out an automated computer figure. Others require a full walkthrough valuation from an actual valuer to inspect the property. And those two figures on the same property can be quite different depending on the market and what's happening at the time. So obviously the aim of the game here is to try and get as much equity out as possible. So we want that favourable valuation. Yeah, so as brokers, we have the ability to quite quickly run all those different types of valuations and come back to the client and let them know this is where it stands, this is the option that's going to give you the most equity, and then formulate a plan from there.
So on the lending equity, so 80% is the point where we're not, you mentioned the example there, if you've got 500,000 of a value of a property and your mortgage, I think it was 175,000, you could potentially get 225,000.
Yep.
And that's then used as the deposit on the next one. But just on that, I guess if someone really wanted to go hard, they could consider mortgage insurance.
Yep.
I guess that's where, do you want to just explain what that might be? And let's say I wanted to go up to 450,000, 90%, just explain what mortgage insurance might be.
Yeah, again, every lender's going to have a different view on that. It'll come down to their policy, but yeah, you're absolutely right. If you're more aggressive, you don't mind paying a little bit of lender's mortgage insurance. Let's say it might be $7,000 or $8,000 to get an extra $50,000 out, and that $50,000 makes all the difference in your property journey. That's an option available as well. So, yeah, the good thing about a mortgage broker is they're the ones who understand what lender's doing what type of valuations are given, what all the figures look like, and they can present to you, right, we've gone through all of the information, gone through the weeds, and here on the plate is the best options available to you to help the clients make the best informed decision.
And we'll come back to cross-collateralisation and why you split the loans in a little while, but just talk about the importance of the capital growth on those properties, why that is so important in building a multiple property investment portfolio.
Well, obviously for this leveraging equity strategy to work, your properties do need to grow in value. If they sit stagnant for 10 years, there's no equity necessarily generated. You're going to have to keep saving those deposits, and it's going to take you a lot longer. So at the end of the journey, you're only going to end up with a few properties if you're lucky, unless you significantly increase your income to save a deposit quicker. So yeah, I mean I'm a firm believer of your most important purchase, and you've alluded to this at the beginning, is your first. A lot of people think, I'm going to go out, buy my home. It's typically what we do. We buy our home first, and then we think about investment after that. If that home doesn't grow in value, that could put you back 10 years potentially. So I try to help clients understand that it's probably not going to be your forever home, so try to remove that emotion from it. You still got to satisfy lifestyle requirements, but you do also want this property to grow. It's for me the most important investment, and if it does really well, and even in less than 12 months, you might have enough equity there in a good market to go again, and you can build up quite a nice quality portfolio quickly. And like we said, the longer you hold properties for, the better they'll do for you over the long term.
I think that's a really critical point, is the time in the property and the market, right? And we all love those markets, and we've all seen the cycles where it's hot and you go, wow, that's up, 20% in some cases per annum, and then you have those other cycles where it goes nowhere for 3-4 years potentially. Yep. So do you find investors get itchy feet? Are they getting itchy feet going, oh, I want to get my next one, this is not working for me, I'm thinking of getting out of here? Do you just sometimes get clients who are a bit impatient?
We do. It's human nature, unfortunately. When things aren't going good, it's hard to just keep faith and keep trucking along and trust the process. But look, property is a long-term game, and long-term, I think, is in property it's defined as at least 10 years. But we want 15, 20 years. If you hold good quality properties for that period of time, you just look at the history of how the market's performed, you're going to do very well from it. So, yeah, I think there's a couple of things there that come to mind as you mentioned that. And, property can be stressful. It's not just going to be set and forget and everything will be perfect. You've got to make sure you have things in place to mitigate that risk. And one of those is cash buffers. So, if you buy a property and something goes wrong, maintenance request or something like that, you don't want to have no cash available to be able to fix it, and then you've got a vacant property, you're paying the mortgage, you've got no rental income. So make sure you've got your cash buffers in place as well. The other key thing that a lot of people don't necessarily consider is making sure that the property is aligned to them as an investor. There could be multiple great properties to go and acquire, but not all of them are going to be best suited to that individual. So, for example, if you buy a property that requires a lot of maintenance, it's a bit run down, but it's got great development potential and it could perform very well if development is the option and that happens. A client that doesn't have the ability to hold it through a tough period or until the feasibility stacks up for the development, they could start getting, like you said, itchy feet and start panicking. And if they sell at the wrong time, that could be it for their property investing journey. So, yeah, if you've got the most suitable properties aligned with your risk tolerance, you're going to have a better chance to hold them for that long period of time.
And look, that's so critical. Myself, I've got properties that are long-run development potential, and look, it can be frustrating. You're sitting there, and the hot water system's gone. This is happening, and you got all this negative cash flow coming out of your pocket. And yes, you get some back on your tax, but ultimately the tax deduction you might get half back. Right? You're not getting the whole lot back, and then it can be frustrating. I think that's just something so critical for all investors. If you're going to invest in property, the development site sounds sexy, sounds exciting. You're going to knock it down in 5 years, build villas, townhouses, whatever that might be. But if you can't handle the heat and the pressure of the negative cash flow, the quality of the tenant might not be that great, right? Because you're sitting in a property that is run down anyway. It's going to be demolished, so you're not going to get necessarily high rent or the best tenant. And I think that's just something so crucial, isn't it, in the strategy you put in place with clients, identifying who they are and their risk tolerance and how much they can wear, because otherwise they get them in the wrong property. They're much more likely to exit, aren't they?
Yeah, absolutely. So a tailored approach is wise here. And that's what we do here at Momentum Wealth. We don't want to even think about what we're going to buy until we understand the investor, what their comfort level is, and also their financial capacity as well. We don't want them in a position where they have to overextend and they're forced to sell.
Yeah, let's cover cross-collateralisation. So if you go to a bank direct, the easiest way they'll say is, great, you've got equity in your house, great, we'll stick it all together, and you can go and buy an investment property. And the reason banks do that is because they keep you trapped. As much as I love our bank friends, they know that cross-collateralisation keeps you sticky because you can't just move one property out. You've got to move the whole loan. So can you just explain what cross-collateralisation is, and generally as a rule why we prefer not to do that when setting up the investment structure for our clients, and how we would generally set it up?
Yeah, for sure. I mean, it's a hard word to say. So, I mean, you should probably avoid it at all costs. So I think, and I learnt my craft in the bank, so I know how they trained me, and it's an easier way to set up your loans, but more so for the bank. But it's not the best result for the investor. So what it is it's when you have a loan secured by two or more properties. That's the easy definition for it. And as you mentioned, you own a home, you've got equity in the property, you go to a bank, you want to buy another one. They'll value your home, there's the equity, they'll give you a loan for the full purchase price of the next property, they'll secure it against that new property, but there's no equity in that because it's 100% LVR, so they need to secure that loan also against your home. Nice and easy, it seems, but the problem with that, and as you start building your portfolio out with that kind of structuring, everything is now tied together. So, the issue is if you want to sell a property, refinance one for better terms, you need to extend a interest-only period, and your existing bank's saying, look, we don't have you don't fit our policy right now. That can't happen. They're going to look at the whole scenario as if it's one. So they're going to value all your properties, get that figure, and look at all your debt and get that figure, and treat you on that basis. So when you go to try and take a property away, if it's the good performing property for them, they're going to reevaluate what they're going to be left with, and they might turn around and actually say no, or even ask you to kick in extra cash, and that might not go. They might not go in hand with your plans. So how we like to do it is you want to keep things separate. So if you've got equity in that home, we like to cash out that equity first, have that cash available sitting in an offset account. You now have your deposit to go and purchase another property, and then you can go and source that purchase loan. And as your properties grow in value, we want to keep doing that. We want to keep things separate. We don't want to be tying it all together.
I think that's just some really critical points there. Firstly, the revaluation. If you've got a property separately mortgaged, it's an residential investment property or your home loan, and pretty much you just pay the bills every time they come in, you're never going to get or almost never going to get the bank to ask you to revaluate. It's set and forget. It's a chicken factory, I line it too. They come in, they get the mortgage, they get them out quick, and you will never hear from that bank again as long as you keep making those mortgage payments and in ordinary circumstances. But as you say, if you want to sell one or you want to do something or revalue one, if you're all cross-collateralised, they're going to revalue everything. And I've been in that situation, thank goodness I didn't cross-collateralise, where your property doesn't go up in a straight line, does it? It goes, sometimes it goes up a lot, and then you might have even potentially a downturn. It can come backwards. But if you want to do something with one of your properties, sell or refinance, and they're all cross-collateralised, well, that triggers a revaluation of the whole lot of them. And I don't think people realise that. They think, the bank's easy, and it's to me it's the lazy way of doing a loan. Banks do it because they get to keep clients. But as a broker, there's got to be a really good reason why you do it, and it's generally why we don't do it. So just to explain that, so people go on my tax situation, but it's not that complex. We're not obviously accountants here and giving tax advice, but as long as you just know what the purpose of the loan was for, your accountant should be easily able to figure out. It's still all deductible, and it's not that complex, really, is it? Yeah,
exactly. It's about the purpose, as you mentioned. It can be secured against any property, even your home, which is a non-deductible asset. If the purpose of those funds was to buy an investment property, you're good to go. So I think, and look, I reckon accountants like the structure anyway, because what we're doing is we're keeping non-deductible debt separate from deductible debt. So rather than just having one home loan that's mixed use and all over the place, you've got your separate loan accounts that you know exactly what those funds are used for. You give them to your accountant, they're happy. Nice quick tax return.
I think the other thing I found too in my journey through property investing is in the background you have stages where a particular lender is really keen to lend money, so they set their parameters in the broking systems, and your serviceability ratio can be quite high. And I'm sure you've seen it where with one lender you can potentially borrow a couple $100,000 more than another lender, but your lender, if you stick with one lender, there's no guarantee they're going to be the best lender in the market that whole property investment journey. And if you want to do something and you're all cross-collateralised and stuck, you're then going to be in a situation where you're really struggling to move. Or if you move, you've got to move everything, which is quite painful. Even if your lender is the best lender, let's say you're with one of the major banks, I won't name them, but even if that is when you come up to buy an investment property, they've got the best rate, the best servicing for you at that particular time, we still don't cross-collateralise it as best we can, do we? We still set them up as totally separate loans.
Yep. So to be cross-collateralised, you have to be with one lender, but you can still take everything to one lender but not be cross-collateralised. So, yeah, you're exactly right. You can still set it up on a standalone basis, and even if you're looking to, again, in that scenario, take a property away from them, even though they hold the mortgages and all the other the loans as well, then they're not required a will. They're not going to look at it. It's got nothing to the properties are separate from one another. All they're looking at is that individual security and what's attached against it.
Growing your property portfolio and the lending strategies really goes hand in hand, doesn't it? And in other episodes, we'll talk about how do we find those high-performing properties. But, Caylum, we've got a special resource that's available for people looking to buy property and utilise lending. Do you want to just tell us about that?
Yeah. So we have a great guidebook called Unlocking Your Home's Potential, and that goes into all the detail about leveraging equity from an existing property to expand your portfolio. So I believe we'll be including that in the link.
So, Caylum, thank you. Well, before we go, I want to get you to give your top couple of takeaways. What would you say to somebody who's looking to build a multiple property investment portfolio and putting on your expertise as the finance guy, the expert in the finance field? What would you say the top tips are?
I think the first one is there's some excellent resource and help out there. Get yourself around a great professional team. Starting with the mortgage broker. Like we discussed, knowing there's all sorts of different valuation types and, banks value properties differently, a lot of clients won't know that. So a mortgage broker can help you, get the best results and take all that stress and all the unknown stuff away. The second, I think, is we touched on this, and again, I like to tell people, make sure you get that first purchase right. That is potentially going to be the make or break for your future purchases. And the other one would be the lending structures. It's quite confusing. It's not the sexy part of when we go and buy property. It's the boring stuff in the background. It's debt. No one really wants to think too much about that. But if you get the wrong structure from the get-go, that could be it.
Caylum, thanks so much for being with me today. It's been fantastic. There's so much that we've learnt, and it's been a great discussion, and how we can build a multiple property portfolio. But specifically, obviously, we covered a lot about the finance today. So really appreciate you coming on. Has been a big topic, and it's one I certainly hope the listeners have taken a lot of value from. If you've got a copy of my book, Property Investing Roadmap: How to Build an Income from Property for Life, you can read more about these concepts in chapters 6 and 7, where we talk about all the key strategies about building a property portfolio. I want to leave you with one piece of parting advice, and that is the drivers of wealth all work best when they're working together, and that is so critical. So today we spoke about finance predominantly, about how that will enable us to buy multiple property investments to build our portfolio, and that is crucial. But it's also crucial about choosing the right property. In other episodes we talk about that. How do we choose that right investment property that'll give us the capital growth that will mean we can leverage to buy more properties? But importantly also, it's time. We'd all love our properties to go up in value 20, 30% per annum. Well, that's not real. There will be that odd year or two where that happens, but most of the time it's going to be somewhere between 4 and 8% capital growth per annum on average. So we're just got to let it get time do its work. But over that longer period, that all those drivers working together build substantial wealth and allow us to build that multiple property investment portfolio. Thanks for tuning in. If you're enjoying the podcast, please take a moment to rate us to help others discover the show. Please note the information shared on Property Investing Roadmap is general in nature and doesn't take into account your individual circumstances. The information is for educational purposes only and should not be relied upon for investment or financial decisions. Always seek professional advice before deciding whether to invest. Today's guests are representatives of Momentum Wealth Finance Proprietary Limited, Australian Credit Licence 384632.